This lesson is Chapter 11, Section 4, Cash Flow and Budgeting. The objectives in this lesson are to develop and interpret a cash flow chart, similarly develop and interpret a frequency budget plan, and lastly, develop and interpret a year-long expense budget plan. So here are some key terms that we'll be discussing in this lesson. I'm not going to go over each of them, but there are some in particular that I'd like to highlight. One of them is the envelope accounting system. Okay, this is very low tech and something that some people still use effectively, and that is having separate envelopes for various expenses and putting cash into those envelopes to pay for those expenses. There's also a debt to income ratio, which is something you're probably not familiar with, and we'll talk about that at the very end of the lesson. But most of the other things here, assets, liabilities, net worth, cash flow, are things that you pretty much should be somewhat familiar with already, but we'll go into in a little more detail in this lesson. So how do you plan for expenses, reduce debt, and grow savings? A lot of this has to do with just record keeping, putting things down, having a plan, trying to stick to it, so that you know that you won't spend more than you're taking in, and just to basically understand where your money is going each and every month. So let's look at an example here. Dave and Joan want to chart their monthly cash flow. Create a spreadsheet that will help them keep track of their income and expenses for the month. So here's a spreadsheet they came up with, and it's divided into various sections. The top left here is pretty much income. This is the amount of money that you have coming in from your primary employment, secondary employment, any other income, but this basically indicates income coming in. The next section, just below that, is for total fixed expenses. These are expenses that are the same every single month, okay? Things like your mortgage, other loan payments. They're constant, they're the same every single month. So they're fixed expenses. All right, the next section down is your variable expenses. These are things like groceries, eating out, things that change from month to month that aren't fixed, okay? You may go grocery shopping and spend a certain amount one day, and a week later you go and you'll spend a totally different amount. So these are variable expenses, but again, tracked monthly. Then if you move over here to the right side, you've got non-monthly expenses, and that are per year. For example, let's see, what do we have here? You've got life insurance, you've got tuition. A key one here is vacation. All right, you might go on a vacation and you're going to spend the money on your vacation at that time. In this case, it was $1,200, but that's not going to be spread out over a whole year. That might be a one-time charge just when you're out on vacation, all right? What they've done here is they've taken these non-monthly expenses and figured them out for the whole year. In this case, they spent $12,000 for the whole year on non-monthly expenses. They divide it by 12, and they come out with the total non-monthly expenses per month. In this case, it was $1,000 per month. So that goes to these expenses that are not monthly, but are somewhat random throughout the year. Now, if you notice up here in the upper left, we had total income, which was $6,100. In the lower right, we have total expenses. This is the fixed expenses, the variable expenses, the yearly expenses prorated per month. And we come out with $59.90. And then the difference between these they call monthly cash flow. You might also call it a surplus, okay? So long as you're taking in more money than you're taking and spending out, this should be a positive number, okay? In this case, it's $110 per month. All right, let's look at another example. The Consumer Credit Counseling Service suggests that transportation expenses be between 6 and 20% of your budget, and savings be between 5 and 9%. Actually, savings, a lot of people suggest that your savings should be 10% of your budget. But anyway, we'll go with these figures here. Using Joan and Dave's cash flow analysis, determine whether they remain within the guidelines for these categories. So let's look initially at transportation. All right, they had $200 for a car loan, all right? They had $60 for car insurance, they had $160 a month for gasoline, and they had $59 a month for car-related expenses. They add all these up and they come out with $479 per month for transportation. Now, they take the $479 and they divide it by the amount of income they have, which is $6,100, and they come out with 7.85%. Now, this is well within the range that is recommended. The range that's recommended is anywhere from 6 to 20%. Well, they're not even 8%, so that is very good. Now let's look at savings. They allot $300 per month for savings. Now, if you divide that by the $6,100 income, that comes out to be 4.9%. Well, this is barely up to the recommended 5 to 9% recommended by the Consumer Credit Counseling Service. In fact, it's probably too low, and they should try to take and save more money. As I said, a lot of people say you should be saving 10% of your budget on savings. They are only requesting you save 5 to 9. Well, they're not even saving 5. They're saving only 4.9%, which probably is not that good. Now, this next example, we discuss a frequency budget, okay? And it states that Dave and Joan have an annual surplus of $1,284. How does this relate to the monthly positive cash flow that was computed in example 1? So we're looking at a frequency budget. Now we're going to compare it to their monthly budget and see how the two compare in terms of cash flow or surplus. So if you look at the frequency budget plan, and you look down here in the lower right, again, I apologize for the small text, but if you look way down here, okay, you'll see the $1,284. Well, if you go back to their budget spreadsheet and the earlier example, you'll find that they came up with $110 per month surplus. Well, if you multiply that times 12, you come out with $1,320, and that's very close to the $1,284. So they're pretty much on track in terms of their surplus or savings, if you will, each month. Now, let's construct a year-long expense budget spreadsheet using the cash flow data from Dave and Joan. So in the past, they created a monthly spreadsheet. Now we're going to create something that's the full year with a spreadsheet. And as you can see, here's your full year. Here's your income up here in the top left. Now, they've divided it up into each month. So you got January, February, March, April, all the way through to December. So they have each of the months listed here. Then they have the fixed expenses just like there was on their monthly spreadsheet. Then you've got your variable expenses, again, just like there was. And now you'll notice for each month, however, these are actually what they are paying. So look, for example, at life insurance. Life insurance, they only have to pay in March, in June, and let's see, September, and then again in December. Vacation, which I talked about earlier. Notice they only have that listed for July, okay? Because that's when they took their vacation, and that's when they spent that money. So this divides things up into what is actually spent or budgeted each month. Things like mortgage, it's the same every month, $2,400 all the way through to December, okay? But then the other expenses that are not necessarily monthly are shown in the months that they are due. Now, in this example, let's look at figuring net worth, okay? Liam Brown is single, in his mid-20s. He owns a condo. He has calculated the following assets and liabilities. So you need to know your assets and liabilities in order to calculate net worth. And previously, the previous year, he calculated his net worth as being $205,780. Now, let's see what it is now, please. So his assets come out to be $673,180 when you add up all the assets, like the value of his condo, his bank accounts, the value of his car, etc. Now let's look at his total of his liabilities. So if he adds up his liabilities, the remaining balance on his mortgage, similarly on some of his loans, his credit card debt, he comes out with $432,600. Okay, so that's the total of his liabilities. We know the total of his assets. We should be able to figure out his net worth. So his net worth is simply his total value of his assets minus the total value of his liabilities, and he comes out with, in this case, $240,580. Now, this compares with what he was worth a year ago, which was $205,780. Why the difference? Well, primarily because he's probably paying off his mortgage, so that liability is going down, and maybe some of the other debts that he has, he's paying down, so they're going down. So therefore, if his income or assets stay the same, that's going to increase his net worth. Well, lastly, let's look at debt to income ratio. That's something you may not be totally familiar with. Okay, we've got a table here. We got monthly liabilities, payments for different loans. We also have monthly pre-tax assets, in other words, income. All right, so on the right here, we've got income. On the left, we've got debt. And we're going to take and see what the debt to income ratio is. So if you take the income, again, remember this is pre-tax income, gross salary, stock dividends, interest, we come out with $8,300 a month income. Now, if we take his debt or liabilities and add them up, we come out with $3,400 in terms of debt or liabilities. Now let's see what his debt to income ratio is. And just like the name implies, we take the debt, which is $3,400, divide it by the income, which is $8,300, and we come out with 40.9% for his debt to income ratio. Now, is this good or not? Unfortunately, it's not that good, because what is recommended is that the debt to income ratio be 15% or less. That's what's recommended. In his case, his debt to income ratio is 40.9%, almost 41%. So somehow he has to decrease his amount of debt, pay off some of his loans. Obviously, if he could increase his income, but that's typically harder to do. But the main thing would be to decrease his debt, and that would improve his debt to income ratio.